Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead. LME 3-month copper. The break above the third of three resistances, this was the neckline of the February to April 2023 head and shoulders continuation pattern, currently 85.24. Back at the start of March, was the beginning of the very recent move higher. This neckline had previously helped cap the market in various times, most recently in late January and late February. However, 5 weeks ago, this resistance was breached and broken. So where does this very recent move higher really originate from? Well, it starts at the base of the congestion between 83.46 to 84.40, containing the September 2012 high at 84.24, the February 2013 high at 83.50, the long moving average currently 84.23, as well as back then the medium moving average, which is actually now currently 85.62. However, the journey higher had been initially a tortuous one, yet in late February the market built on the congestion below 84.40, plus the short medium moving average back then, which is currently at 86.70. And finally, a golden cross of the medium moving average up over the long moving average just over 5 weeks ago, and staged an eventual move up over the neckline. So what now? Well, 2 weeks ago I drew a bright red highlighted late October 2023 to early February 2024 bullish Andrews pitchfork to show the bullish angle of attack of this market. Prices pushed up over the middle time 3 weeks ago, currently at 89.43. Stalled for the first time on approach to the upper time, currently at 93.81, back in mid-March. Prompted, I think, by the somewhat surprising resistance of the 38.2% Fibonacci line, with the big October 2020 to March 2022 move at 90.97. Then fell away down to where we found support again at the end of March, at the bright red middle time, with I suspect some unusual help from the rising short moving average, currently at 90.65, and even perhaps the 50% Fibonacci line for the whole of 2022 at 8900. Then gapped higher over the weekend, 2 weekends ago, to stage a strong rally last week that seemingly again faltered at the bright red upper time, before pushing up through it quite vividly yesterday. What is interesting here is there is no fallback position back onto a bullish shift pitchfork here. This is it. What you see is it. So far, I have to call this upper time breached, but not as yet broken. Last week's gapping opening higher is still there, and I wondered the following last week, and I quote, if the action of the last 3 weeks, so that is 4 weeks now, if the action of the last 3 weeks may have left us with a question. Is this action a bullish halfway hesitation, or is it a potential double top? End of quote. Right now, I'd say it looks very much like a bullish halfway hesitation. I have a preliminary potential target for such a pattern already achieved in the 93.70 area. However, a secondary and more extensive target X, a harder to reach target, is up in the 95.50 area for the same extended pattern. It is synonymous with the 2023 high. It will all depend now on whether the bright red upper time corrals the market back within the pitchfork, or at least makes prices run along the outside of the pitchfork. LME 3-month aluminium. I keep repeating myself here. There was, and I suppose still is, a lot going on here, and I sometimes think my trying to explain it may even have made it more complicated. Let's start with the shallow reverse head and shoulders continuation pattern neckline of the June to July 2023 move at 22.48, highlighted in bright green on my daily chart. The final break upwards over it in early March, after 2 earlier failed attempts this year, moved prices up to the next neckline, the dark green highlighted October 2022 to May 2023 head and shoulders top pattern, currently at 23.08. Now, up until that point, indeed 8 weeks prior to today, I'd clarified what I saw thus, and I quote, over this last week, so that is nine weeks ago, over this last week, another pattern started to develop in my mind, and I've drawn it unhighlighted on my daily chart. It is a late October 2023 to date possible potential diamond pattern. It is not a pretty pattern, but I would pay close attention to the converging trend lines for this pattern. I'm not in love with this pattern. I'll retire if it does not perform, but it does have merit and it is one to watch. End of quote. 6 weeks ago, I chose to highlight this pattern in dark blue on my daily chart. It's still there. It still does not look the best looking diamond pattern type, but as I said earlier, it does and still does have merit, especially on this recent break higher. Thus, 3 weeks ago, I laid out some potentials topside for such a pattern. Hence, we'd have a primary target X in the 2412 area and a secondary harder to reach target X1 in the 2491 area. A key factor in prompting me to lay out these potentials had been the break higher in early March, the one I spoke about earlier, and the move 4 weeks ago out of the small February to early March bear channel. This bear channel also had its own potentials topside of a primary target X2 up at 2336. 2 weeks ago, prices punched up and reached target X2 at 2336 and carried on higher, such that last week prices reached the primary target X at 2412 and exceeded it. Such that we have recently tested the 38.2% Fibonacci line of the April 2020 to March 2022 move at 2441 and the April 2023 high at 2462, as well as being on our way towards target X1 up at 2491. So, okay, last week being well on our way towards X1, I highlighted two final things, and I quote, "The first might end up being a big thing in the future. We had a bow tie formation late 2 weeks ago, which is now 3 weeks ago, of the rising short moving average, currently at 2341, slowly rising short medium moving average, currently 2265, and the barely rising medium moving average, currently 2248. For any who follow bow tie formations, you can easily see that these moving averages are in the wrong order. However, that being said, the theory indicates that the market will move in the general direction of the outgoing moving averages from the bow tie, which, to be honest, originally looked sideways, but now is becoming clearer as a move higher. Additionally, between 15 to 20 sessions after the crossover, we may see a significant move from this bow tie, in this case. And allowing for some holidays in between, the market may have a move between, and this is where it gets interesting, between the 9th and the 16th of April. I will not wait with bated breath, as I am not happy about this bow tie formation at all. Finally, we had a golden cross last week of the short medium moving average up over the medium moving average. This may be a lagging indicator, but it is still there, just after a bow tie formation. And it adds some comfort to the overall idea. As you can see, we are in that period when we should be having something active happening because of the bow tie, and we are seeing something active happening because of the bow tie. I don't think I can add much more to what I've already said last week. LME 3-month lead. In late January, prices dropped out of a December 2023 to January 2024 based bull channel, all the way down to the congestion around 2000 even in mid-February. This support was not a spectacular congestion, but enough to hold prices in a pipe bottom 8 weeks ago. After this, the market rose up into a very steep ascending wedge pattern, highlighted in bright red on my daily chart, before breaking low at the end of February, again, only to be held at the same support seen back at the start of this year, the January 2020 high at 2039, and leading to a fresh rally 6 weeks ago. This rally saw the market break higher over the 50% Fibonacci line of the March 2020 to March 2022 move at 2135, and the 50% Fibonacci line of the May to November 2023 move at 2142, and even the November 2023 to February 2024 move at 2151. However, as I said 4 weeks ago, and I quote, "I suspect the key overhead resistance will be the same as in late January, congestion between 2182 to 2189, end of quote." And please remember this quote, 2182 to 2189, as it becomes relevant again with this week and last week's actions. Prices peaked 4 weeks ago in the middle of the week, with a high that was importantly lower than the one in late January. Prices then dropped down thereafter, below all the moving averages, below the January 2020 high at 2039, and almost down to the February low at 1994. enough to say that prices effectively reached it. I've connected the lows since October last year, extrapolated it back to mid-July, and highlighted it in dark blue on my daily chart. It's currently at 1988. It's not a part of any shallow bear channel, but it's enough that I began paying it special attention, including the very dramatically key reversal up based right on it, made 2 Thursdays ago. However, despite this key reversal up, a question I put forward 2 weeks ago still rings in my ears, and I quote, "All this action is making the big picture very clouded. All I have now is a consideration that perhaps, just perhaps, the action since November last year is a really big cat's ears pattern. It is too early to know just yet, but I'd like to lodge that thought in your minds just in case." End of quote. Last week we were close enough to the dark blue trend line for me to still consider that, but then last Tuesday saw a dramatic counter to the counter key reversal up that halted at the short medium moving average, currently 2092. What is more, prices after this moved higher, utilising the short medium moving average as a base as recently as yesterday. All this bullish action puts a severe dampener on the idea of a big cat's ears pattern, and brings to the fore the idea of a late January to date double bottom pattern type. It's here that I bring back in the earlier quote made 4 weeks ago, and I quote, "I suspect the key overhead resistance will be the same as in late January, the congestion between 2182 to 2189. End of quote. Now, if prices do not even make it as high as the mid-March high in this rally of 2172 before falling away, then the double bottom pattern idea is dead. It all now depends on that high and on the congestion further up between 2182 to 2189. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.